What if the things you own aren't really yours anymore? Not stolen, converted. Your house, your money, even government bonds, turned into tokens, traded 24/7, sliced into fractions, moved across invisible networks. It sounds like freedom, liquidity, access. But something doesn't add up. Because when a real asset becomes a token, who actually controls it? The code? The platform? The institution behind it? Or the one holding the token? Beneath the promise of decentralization is a system most people never see, where ownership is separated from control, where assets live in legal structures off-chain, and tokens are just the interface. And if that's true, then this isn't just innovation. It's a shift in power. The question is, who is it shifting to? Welcome to this explainer. Let's dive in. But real quick, before we get started, this video on the channel Block Spawns Funds is created for educational and informational purposes only and does not constitute financial or investment advice. Okay, let's get into it. So let's start with the basics of what's actually happening here. We are seeing real physical assets being converted. And to be clear, we aren't talking about native digital assets like Bitcoin, where the token literally is the asset. No, we're talking about tangible things. Real estate, gold bars sitting in a physical vault, sovereign debt. These are being turned into digital tokens that represent that physical value on a blockchain. It's essentially a dual state system, right? You have an off-chain registry, that's your legal truth, and an on-chain smart contract, which is your computational truth. The physical properties just get layered with all this digital metadata, like ownership percentages, wallet IDs, and timestamps. Now, why are we even doing this? Well, the pitch is incredibly seductive. This tech promises this sort of futuristic utopia of instant trading, fractional ownership, and true global access. I mean, imagine buying a $50 fraction of a commercial high-rise in Tokyo, or trading a piece of a U.S. Treasury bond at 2 a.m. on a Sunday. It literally lights up connections worldwide, totally bypassing those annoying traditional bottlenecks like banking hours and endless middlemen. It sounds like pure financial democratization. But come on, it sounds a little too perfect, doesn't it? Something just doesn't quite add up. Let's hit pause for a second and think about what happens when the system glitches. What actually happens if you tap sell on your smartphone app and absolutely nothing happens? Or think about this. What if the blockchain says you own a piece of a building, but the local land registry says you definitely don't? When you strip away all that futuristic gloss, you're left with a surprisingly complex, fragile architecture, trying to bridge the physical and digital worlds. Which brings us to Section 1, when real assets turn into tokens: power, control, and risk. And just to put into perspective why this matters right now, we're not talking about some niche little experiment anymore. Billions of dollars are already flowing into these ecosystems. We're looking at over $174 billion in stablecoins, nearly $9 billion in private credit, and over $6 billion combined in U.S. government and corporate debt. That is a massive, massive migration of traditional capital directly into blockchain environments. Now, it's really vital to understand the shift happening here. Think about traditional securitization, like how mortgages were bundled up in the past. That just digitizes the paperwork through centralized intermediaries. Tokenization, on the other hand, attempts to digitize the actual ownership via decentralized smart contracts. It's actively trying to replace the middleman with self-executing code. But here's exactly where the illusion starts to break. If your token lives on this decentralized, trustless blockchain, where does the physical house or the gold or the legal contract actually live? Because a blockchain simply cannot inherently enforce property rights in the physical world. This creates what's called a separation of title, or a legal fork. Think about it. If a hacker somehow steals the private keys controlling your real estate token, but the physical deed down at the county clerk's office still has your name printed on it, who actually owns the house? Well, let's break down how this is actually structured. Because when an asset becomes a token, it splits into layers. Step 1. The real asset sits completely off-chain, locked safely in a vault or traditional registry somewhere. Step 2. That asset is legally owned by a special purpose vehicle, or an SPV, which is just a standard traditional corporate entity. Step 3.
That SPV is then linked to a smart contract, the code deployed on the blockchain. And finally, step 4, that smart contract is what actually issues the token into your digital wallet. When you look at it this way, the hidden infrastructure gets totally exposed. To protect investors in case the tokenizing company goes bankrupt, the industry defaults to this SPV-based tokenization. Why? Because direct tokenization is a legal nightmare and often isn't even recognized by courts. So in these SPV structures, the actual legal ownership and the insolvency protections are completely held by that off-chain corporate entity, not the blockchain, meaning your shiny digital token is actually tethered to a very traditional, heavily centralized legal contract. And because of this legal reality, the token sitting in your digital wallet isn't true decentralized ownership in the way you probably think it is. It is really just an access key. It's a claim tied to a traditional legal contract held by an SPV. You own a digital representation of a fractional share of an off-chain legal entity. That's it. Without that off-chain legal enforcement backing it up, your token is literally just metadata sitting on a network. And guys, this brings us to a huge realization. Power hasn't been democratized here. Control has simply moved. It moves straight to the massive institutional custodians, the traditional banks and trust companies that actually hold the physical assets. And it's moved to the developers and administrators holding the upgrade keys for the smart contracts. You are essentially trading one highly visible set of intermediaries for another, often way less visible set of controllers. Now, bridging these two distinct worlds, the off-chain asset and the on-chain code, are things called oracles. Despite this super mystical name, they aren't crystal balls. They're just third-party data providers. Their whole job is to feed real-world data like the daily valuation of a bond, a property appraisal, or current interest rates directly into the blockchain, so the smart contract actually knows what to do. They act as the eyes and ears of the blockchain. But right there, that creates a massive new vulnerability layer. Because what if the oracle is wrong? What if there's data latency, like a delay between the real-world price dropping and the blockchain finally updating? Think about traditional funds. They update their net asset value, or NAV, on a delayed schedule. If a tokenized asset relies on that delayed pricing, but the smart contract is built to execute liquidations instantly, an oracle glitch could force the contract to liquidate your assets based on entirely false or outdated data. And listen, these aren't just theoretical warnings. The risks are escalating fast. Just look at the jump from 2023 to the first half of 2025 alone. We are talking about nearly $14.6 million lost to these specific types of exploits. Millions upon millions lost to on-chain operational failures, hacked smart contracts, oracle price divergence, where attackers actually manipulate the data feeds, and compromised cross-chain bridges. So by tokenizing these assets, we are inadvertently introducing completely new systemic risks into the global financial system. We are talking irreversible smart contract coding vulnerabilities, where one tiny bug can drain an entire protocol. Custodial monopolies, where a failure at one major institution could crash dozens of platforms all at once. The constant, looming threat of oracle manipulation, and of course, the incredibly complex legalities around bankruptcy and clawbacks if that off-chain SPV suddenly fails. Which leads us to the ultimate paradox of this entire system. This research piece perfectly hit the nail on the head. When a critical protocol faces insolvency, large stakeholders intervene, effectively assuming control to prevent a total collapse. It's incredibly ironic, right? During a crisis, these supposedly trustless, fully decentralized systems immediately require top-down intervention from centralized institutions just to survive. When things go wrong, the big stakeholders, the centralized exchanges, and the administrators step right in. They alter the code, they inject capital, they assume control. It completely contradicts the whole permissionless ideal of decentralized finance. So to wrap up this explainer, I want to leave you with this one thought to really ponder. We were promised a financial revolution, right? One that would finally bypass all the traditional gatekeepers. But if the physical real-world assets are still sitting in bank vaults, and the legal ownership is still structured through traditional corporate SPVs, and the crucial data feeds are still managed by centralized oracles, is this actually a revolution of decentralization? Or are we just witnessing a highly sophisticated, technologically advanced shift in centralized power? Keep questioning the systems beneath the surface. Catch you next time.